right, it's Andrew Johns here, the 16th of August, Friday afternoon. It's been a wild week in the markets. We saw the Dow Jones have a drop of over 800, or just over 800 points. I think it was on Tuesday, largest drop on the Dow Jones index in a single day this calendar year. Here's the big drop that happened, and a little bit of recovery that happened at the later end of the week. We've also seen the 2-year bond yields on U.S. government bonds pay more than the 10-year. So an inversion point that has been very relevant to the signals of a potential recession. I want to talk to you quickly about how this impacts or will potentially impact your investment portfolio. Here's the Fed funds overnight target rate. So this is the amount of the rate, the overnight rate or the target rate that the Federal Reserve sets for the entire U.S. economy. General rule of thumb is that when the rate is high and falling, the Federal Reserve is dropping rates. It's because they see the economy cooling down and they're trying to keep the economy propped up. And that's, of course, what we saw here during 2008 when the financial crisis occurred. And then from 2008 all the way until 2015, there was basically a recovery period from the economy's perspective. Now, how did this translate into the actual stock market? Well, if I pull up the Dow Jones here and I go to a 5-year term, you can see the U.S. market did very well over the last 5 years. And if I scroll it even further, going all the way back to 2008, here it is here. Look at this bull run that we've had. I mean, basically, you've had nothing but a positive upward trending market for the last 10 years, okay? So this has been great for equity investors. We've also seen bond investors generally do pretty well. When bond investors started to see the pain of a rising rate environment was here in the beginning of 2016, okay? Rates started going up. Federal Reserve saw the economy starting to heat up. They wanted to also make sure they have enough powder in their powder dry to be able to do what they've just done here on July 31st, which is cut rates for the first time since they last cut rates in 2008. The central bank, this is their number one tool in trying to manage the heating up or the slowing down of the local economy, the U.S. economy. And how this translates into your investment portfolio, if you're a fixed income investor and we're in a declining rate environment, it means that what you're getting on your money today is going to be more than what you're getting on your money tomorrow. And this relates to the yield curve. So the 30-year yield curve in the U.S. is currently paying, all the way out here, is paying just over 2%, okay? So just over 2%. The 30-day is also paying just over 2%. And anywhere in between is less than 2%. Basically, the market's anticipating that there won't be more than 2% inflation for the next 30 years, which is obviously completely unpredictable and a little bit ludicrous. But what's more important here is this inversion, this downward trending yield curve, meaning that you get less for your money if you invest it out for a year than you do for 6 months. You get less on your money if you invest it out for 2 years than a year. Okay, and this is an environment where we encourage our clients to really focus on yield preservation, not yield maximization. So yield maximization is when we are in an environment where rates are going up, like we were this time last year. This is what we were at. Rates were going higher. Your job is to basically try and capture the best rate you can without going outside of your liquidity constraints. But that's not the case anymore. So what we're recommending clients to do, and I'm going to now switch to the Canadian bond market. Okay, so if we go here, we'll see here, this is the Government of Canada overnight lending rate. Now, what you'll notice is there's been no change by the Bank of Canada at this point. I say Government of Canada, it's the Bank of Canada. They're the ones that determine the overnight lending rate. We had a period here where the rates dropped during the financial crisis. The Bank of Canada tried to raise rates, and they did for a short window, slightly different from the States, during this period here. And then they had to drop rates here in 2015 because they saw the economy slowing down. And then they started raising rates pretty aggressively from 2017 till near the end of 2018. And now they've stalled. In fact, not only have they stalled, but if you look at the probability of if you look at the futures market and the probability of the Bank of Canada cutting rates is really starting to become important. This table here tells you the probability of a rate cut over the next set of meetings. So the Bank of Canada is going to have these meeting dates, okay? The next one is going to be on September the 4th. There is basically a 27% chance of a rate cut. So very, very slim. However, the next one, which is October 30th, there's a 66% chance of a rate cut. General rule of thumb, when the rate cut probability is higher than 65%, it's almost guaranteed that the central bank, in this case the Bank of Canada, is going to cut interest rates. And in fact, you can see the probability gets higher to the point where there's basically almost 100% certainty the Bank of Canada will cut rates by June of next year. But what's also important is to look at how much they'll cut rates by. Right now, the overnight rate is at 175. And keep in mind, I'm going to talk about how this correlates to your bank account and prime rate, because this is all rate. This overnight rate is correlated with prime. Basically, the banks, the commercial banks like RBC, TD, whatnot, they don't change the prime rate until, generally speaking, until the Bank of Canada changes the overnight rate. So what we can see here is there's a 51% chance that on October the 30th, there'll be a quarter-point rate cut. There's a 14% chance of a 0.5% rate cut, which is pretty significant. And if you go out into December, it's starting to even get higher. There's almost a 1 in 4 chance that by December, rates in Canada will go down by 50 basis points. Okay? Now, how does this translate into your strategy for your investment portfolio? Well, if you are currently investing your money and you know that you're going to get a lower rate of return, so this is the 5-year yield curve. Basically, the blue is what you're getting on Government of Canada bonds based on 3 months all the way out to 5 years. And you can see that right now you get paid more on a 3-month than you do on a 5-year. The natural sort of inclination would be like, well, then why don't I just keep my money in 3 years and wait until the rates go up? But they're not going to go up. That's not what the market's showing us. The market's showing us the rates are going to continue to go down. And so there are times when it makes sense to focus on preserving a decent yield as opposed to trying to get the very best yield. Okay? Yes, you could keep your money in very short term. A lot of our clients right now are getting what's called prime minus and then a number on their cash. Okay? So if you're getting prime right now, by the way, is 3.95%. Okay? 3.95. So if you're getting prime minus let's say 1.7, okay, you are going to be earning right now 2.25% on your cash, okay, versus a 1-year GIC is paying, call it, say, 2%, okay? So it's a difference of 0.25%. If you have, say, $1 million, that's $25,000 a year difference. However, here's the thing that you've got to consider. And we have a lot of clients in this situation today. Their bank is paying them a very high rate of interest on their cash, okay? But the bank may cut that rate. It doesn't even have to happen by the bank, the prime rate. Banks can elect to say, you know what, this is becoming too costly for us to be paying a client 2.25 when the rest of the market is way below 2%. Plus, on top of that, if the Bank of Canada decides to also cut interest rates, there's a very good chance that the rate you're earning right now at 2.25 or 2.3 or 2.4 could easily drop below 2% before the end of the calendar year. So we're recommending that clients take at least a portion of their money and put them into 1-year terms. It could be a 1-year cashable GIC where you're going to get about 1.8%. It could be 1-year fixed term GIC that's running around the 2% range. But at least it's preserving a yield for you that you can keep for the next year or potentially even 2 years. We have a lot of clients that we have run for them what are called laddered portfolios, and a laddered bond or laddered GIC portfolio ensures that you have maturities coming due on a regular basis, so that if you need the money for payroll, capital projects, etc., you're always going to have money coming due, but at least you're not going to have your money all sitting in cash and being at risk of seeing that rate continue to go down with the rest of this market. If you'd like more ideas on how to do this, we can give you a hand. Mike Regan on my team did a phenomenal job in building out an Excel table that shows you the sensitivity to your portfolio. Basically, plug in your numbers. You got to plug in how much cash you have, what rate of interest you're earning from your bank, and you plug this in, and then we use these numbers here. Let me just show you again. Going back to the market probability table, we'll use these numbers here to basically give you an idea, again, keeping in mind that right now there is pretty much bang on an almost certainty that the rates are going to get cut by the Bank of Canada. You can plug in these numbers. This one's 0.25%, this one's 0.5%. Take a look at what impact it'll have on your portfolio. Again, I got to reiterate, I was pounding the table a year ago when rates were rising in a normal rate environment. You want to be maximizing your yield, okay? You want to basically be getting the best rate. This is what this is all about. You want to be able to get the best rate you possibly can when rates are going up, okay? But we're not in that environment anymore. Rates are going down. You want to be able to preserve some of your funds. If this doesn't make sense, give us a call. I'll try and explain it in more layman's terms, but hopefully this video gave you a good summary of how this works. And good luck, folks. It's been wild times in the market, and it's probably just going to get more wild. Good luck.